Argentina's currency is in free fall. In just 3 days, its central bank burned through $1.1 billion defending the peso and still lost. Meanwhile, across the Pacific, China's households are sitting on $23 trillion in savings, almost equal to America's GDP. But instead of flowing into U.S. treasuries, that cash is moving into gold, Chinese stocks, and swap lines with countries Washington can't touch. And Trump's tariffs? They've pushed U.S. solar costs to 6 times higher than China's. Argentina's meltdown isn't just a local crisis, it's another crack in the dollar's global system. When Javier Milei swept to power in 2023, his bold promise was to scrap the peso and adopt the U.S. dollar. He inherited an economy in freefall, with inflation rocketing past 150%. For millions of Argentinians watching their savings evaporate, his radical proposal felt less like a gamble and more like a lifeline. Argentina is a country scarred by a long history of economic instability, most famously the hyperinflation of the 1980s. With decades of currency crises destroying livelihoods, the trauma was fresh. In this perpetual storm, the dollar became a symbol of stability. The promise to officially adopt it sounded like salvation. But the path from promise to practice has been brutal. To replace every peso, Argentina's central bank needs a massive war chest of US dollars it simply doesn't have. The country is shackled by enormous foreign debts. $45 billion to the IMF and another $11 billion to private creditors, all denominated in the very currency it needs to accumulate. Every interest payment on this debt drains the country's scarce dollar reserves. This creates a paradox. Argentina must spend the dollars it needs for dollarization just to service its existing debts. An IMF review confirmed the hemorrhage, with nearly $1 billion leaving the central bank in just 30 days. On the surface, Milei's chainsaw austerity did curb inflation, slowing it from 150% to 33% by August. But this victory came at a devastating social cost. Deep cuts to public spending, pensions and subsidies meant lost jobs, and a sharp rise in the cost of living, pushing the poverty rate well above 40%. Meanwhile, the public's faith in the peso crumbled. Argentinians rushed to exchange savings for dollars, weakening the currency further. To bring in fresh dollars, Milei slashed export taxes on key commodities like corn and soy, hoping to incentivize trade and replenish the central bank's coffers. But the lost tax revenue blew a hole in government finances, forcing more austerity. International investors saw this contradiction, gutting revenue while social unrest simmered and fled. The market's verdict was merciless. Argentine bond yields soared to crisis levels, a clear signal of extreme default risk. There were no takers. It was the ultimate trap. When investors believe your currency is collapsing, even double-digit yields don't matter. The dollarization gamble was caught in a fatal loop, unable to acquire the dollars it needed to succeed. At the same time, China's $23 trillion savings glut is reshaping global markets. Instead of US treasuries, money is heading to Chinese equities, where the CSI 300 has outperformed Wall Street 2-1, and into gold, where demand keeps breaking records despite prices topping $3,500 an ounce. Argentina, strapped for dollars, turned to Beijing for relief, tapping a $5 billion swap line in April. It bought time but deepened dependence. Politically, Milei is weakening. His party just lost Buenos Aires province in a landslide. Markets punished him instantly. The Merval index plunged 12% the next day. Investors are asking the hard question: can Milei actually govern without public support, or will Argentina slide back into its old cycle of crisis? History isn't reassuring. The IMF's record bailout in 2018 collapsed within months. Back then, the peso broke the model. Today, the same dynamic looms large. When global liquidity dries up, Argentina is always the first link to snap. But this time the backdrop is China's staggering industrial dominance. This isn't a gradual shift, it's a takeover of the industries powering the 21st century. Beijing now controls over 80% of the solar supply chain, 60% of wind turbines, and 75% of all EV batteries, a result of decades of focused, state-led strategy. The costs expose an unbridgeable gulf. A Chinese solar module averages just 11 cents per watt. The US equivalent is over 40 cents. A cost stack breakdown shows it's not just labor. It's massive scale and total vertical integration, from refining raw silicon to final assembly, that crushes costs, creating a mature ecosystem. Tariffs have proven an ineffective response. They don't fix the fundamental cost disparity. They simply make green energy projects in America and Europe more expensive. Global markets follow the laws of economics, flocking to the most affordable supply. This economic reality is forcing a strategic retreat in finance. Venture capital is adapting, pulling back from Western hardware startups. The new strategy is pragmatic: joint ventures with Chinese industrial giants to gain access to their unbeatable scale and supply chains. The foundation of this power is China's chokehold on the industrial midstream. While minerals like lithium and cobalt are mined globally, they are overwhelmingly refined in China. Beijing controls over 70% of both lithium and cobalt refining, creating a crucial bottleneck the world depends on. This vertical integration creates a dependency loop. A Western company might own a mine, but they must ship the raw ore to China for processing, then buy back the finished components. This structural advantage gives Beijing immense pricing power and ensures its champions remain untouchable. The geopolitical consequences are escalating. Europe is trapped between protecting its legacy auto industry and pursuing climate goals. When Brussels imposed tariffs on Chinese EVs, Beijing immediately retaliated against European agricultural goods, weaponizing economic interdependence. China's influence also moves global commodity markets. As the world's largest consumer, its strategic decisions create waves. When Beijing recently decided to stockpile copper, prices spiked 14% in a month, impacting manufacturers worldwide. This volatility hits resource-exporting emerging economies the hardest. Their national budgets and economic stability are now increasingly subject to the procurement strategies and industrial planning cycles dictated from Beijing. And beneath this industrial realignment, the architecture of global finance is shifting. Industrial power is translating into monetary influence. As more goods are priced in yuan, more trade is settled in yuan. The recent SWIFT data is a landmark moment, a direct consequence of this might. While the US dollar's dominance remains secure for now, the trend line is undeniable. Every yuan-settled transaction chips away at the dollar's exorbitant privilege. Economic gravity is pulling the world's financial center eastward, following the flow of goods. Which brings us back to Argentina, a nation caught in a decades-long cycle of economic despair. With inflation soaring past 200%, the peso had become virtually worthless. In a radical gamble, President Javier Milei bet the country on dollarization. The theory was simple: adopt the US dollar to kill hyperinflation and restore confidence. But the theory collided with a brutal reality. To dollarize, a country needs a massive stockpile of dollars, and Argentina's central bank reserves were empty. The plan spooked markets. The world was in a dollar shortage, driven by the US Federal Reserve's aggressive rate hikes. The currency Milei needed was scarcer and more expensive than ever. Argentina is learning the hard truth: when global dollars dry up, even countries that tie themselves to Washington can't find relief. Meanwhile, a different strategy is unfolding in Beijing. Observing the dollar's volatility, China is orchestrating a monumental financial pivot. For years, it was the world's largest buyer of US debt. No longer. Now it's systematically channeling its national savings away from treasuries. They're buying gold at a record pace, storing it in domestic vaults and pouring capital into their own stock market, the CSI 300, to fuel strategic sectors like technology and green energy. Washington's response has been to turn inward. Tariffs were designed to kneecap China's industrial might, but they've backfired. For industries like solar and EV batteries, China's dominance is absolute, controlling the entire supply chain from mine to final assembly. The tariffs simply raised costs for American consumers, making green energy transitions more expensive, while accelerating China's push for self-sufficiency and entrenching its dominance in global markets. And for dozens of other dollar-dependent economies, the burden grows heavier. Argentina is the canary in the coal mine. A president gambling on radical dollarization now faces collapsing reserves and hostile markets. Into this vacuum, China steps in with an alternative: a currency swap line in Chinese yuan. It's a lifeline that pulls Argentina into Beijing's orbit. The US, preoccupied with protectionism, offers no counter-move. The peso's collapse, China's strategic pivot, and America's industrial losses aren't separate threads. They're one story. Argentina's crisis isn't just about a failing peso, it's evidence of a system where the dollar itself, once unshakable, is becoming a liability. The dominoes are lined up. If Argentina is the first to fall, the real question is, who's next?